All right, so welcome to our September Elite Wealth Management webinar. Today we're going to talk about investments, what we're seeing in that perspective, as well as the economy, markets, a couple things going into the election of that nature. We will also be talking about tax loss harvesting. So that's something we'll be looking at towards the end of the year. Before we get to that, though, we have our wonderful disclosures that you guys get to look at every month. So thank you. They have since changed now that we've left LPL, and this is a good time, I think, to address what we've been talking about in the Q&A and some other stuff over the last few months. So those of us who have been through the transfer from LPL or other custodians over to Fidelity, thank you. We are now seeing the light at the end of the tunnel and figuring out that it is an actual light and not a train coming at us. And we know it's been a lot of work on y'all's end and, also ours. And, just from my view, a applaud goes out to our staff working on that. And then also you guys as the clients. Thank you for that transition. So again, we do not have a guest speaker this month, but we are going to have our normal advanced planning section. That's going to be on tax loss harvesting. And with Kat Greer on and myself, we might do a little bit of Q&A around tax loss harvesting, as well as some specific strategies that maybe some of y'all aren't aware of that we want to start incorporating in your portfolios. All right, so what are we seeing on the investment side? So in our minds, we're really at an inflection point. And, this is most clearly signaled by the Federal Reserve finally, for the first time since pre-COVID, lowering interest rates. And when that happens, it doesn't always signal the start of a new cycle, but usually that's included as part of the new cycle. And so we've had a lot of struggle 2023 towards the end of 2022 of interest rates climbing and the impact of inflation. You felt that in stocks, you felt that in any borrowing costs. And now, though, what that has created that's good is a opportunity, and you'll see this on the slide, of direction of interest rates, of making a lot of money now in those bonds where the returns haven't been that good. But if you get this higher yield we're at now, somewhere in the neighborhood of around 4 to 6%, depending on the credit quality, and rates go down, you're going to get some good returns. And then the other thing about this inflection point, and this is always interesting, is watching right here this group known as the Magnificent Six, or seven, depending on who you talk to. Certainly 6 of the 7 are not doing all that, or 6 of the 7 are underperforming other segments at this point. But our blessed NVIDIA, it just keeps running. And one of the things that's showing is a little bit more of a return to rationality on pricing. And when you think of inflection points, one style in investing, and this is always a true style that will work at times, but it only works for so long, and that's momentum investing. So what strategies have the momentum? What strategies are getting money added to it? And we really saw that with those large growth names, and it's nice to see some stuff flowing out. And then why do we have this artificial intelligence here? Really, a lot's been done about AI, and a lot of what's happening with AI is it's so under the radar, but what it really can help businesses with a lot is having more efficient supply chains, which in turn will lead to lower inflation. And so the way I look at that, I heard a story this past month at a small business development conference. We were there presenting, talking to small business owners. We started a department on business valuations. And one of the things we were talking about was the impact of technology. And at that presentation, or at that conference, it was huge all around the country. And the area was the most important was actually the Midwest. And a lot of the people in the Midwest were weren't all that excited about broadband and some of the AI stuff until they figured out what it could do on their farms. And they realized that now they can get, just a massive amount of work done cheaper as farmers in a place like, Indiana, than the way they could do it before. And that's going to come through in possibly, I'm not saying it will, but possibly be the kind of catalyst you need to one day not walk into the grocery store and have complete sticker shock. Again, not a promise, just a observation. All right. So that's where we see ourselves in the inflection point. And please, if you have any questions, I'm not able to man the chat that well while uh, presenting, but just go ahead and interrupt me as well. Okay. Then we're talking about the stimulus. You know, a lot of conversation over the past few years has been the stimulus leading to the inflation we saw. And whether that is true or not, there can be an argument that it's more supply chain oriented. I think the truth on this is it's more than nothing, but it's not everything. And you can say the same thing about the supply chain in any variable. But the point of this and where we're really starting to observe it is on the back end and understanding its impact and the things that happen, but really starting to see some of that move away and therefore get to some price stabilization, which even though it's not necessarily bringing down prices from the standpoint of, oh, I'm going to the grocery store and paying what I used to, it is bringing them down from the standpoint of they're no longer growing so fast that the Federal Reserve is afraid to lower interest rates. And that is definitely true, or else they would not have lowered interest rates, I personally believe. All right. All right. Now, the big elephant in the room. Sometimes. Depends on what room you're in. Others, it's a donkey. All right. That was a joke. But the presidential election, and here's the thing, even if you take a view on politics like I do, which is it's pretty much a separate discipline and that separate thing from investing, it gives us as investors more noise than it does value, most likely, if we're trying to decide what investments to make. I still can't get it out of my mind because I get like 15 texts a day. I see more commercials than I care for, and everyone's talking about it. So, you know, we're going to be thinking about it. And what it's really showing here, and I find this very interesting, that every presidential election year, this always gets brought up. It's showing that September and October are historically the most volatile months. It's actually that way almost every year. It's usually, you know, late summer into the early fall, and then you see a good rally at the end if you have an up year. Certainly 2023 is the poster child of that. A lot of you guys got, you know, mid-teen returns, but you really didn't make any money for the first 10 months, and a lot of money was made in the last two. So anyhow, I would say if we see this, it's historically normal. And what I would throw out is, at least logic to me, is that maybe one reason it tends to do well after the election compared to before has more to do with businesses knowing what the playing field will be than it being a good or bad playing field. And the reason I say this is this seems to be consistent across all elections to some degree, but it's also just a cyclically strong time of the year. And then, you know, once again, different way of saying this. There was a time, you know, you know, certainly what are the average returns? Okay, September's historically been, you know, the weakest of all months, but I'm not sure I read much into these statistics. You know, they're going to be there when you only have 100 years of data, but not necessarily mean they're relevant. And then this is very important. And this is really talking about that Magnificent Six that we talked about, which is, you know, some of the momentum goes out of there. All of a sudden, you're able to see some really good gains that we really think are kind of behind where they should be for right now in mid cap, small cap, possibly even some international, definitely value, you know, all these different things that have really been, in our opinion, you know, people often come to our office and say, aren't stocks overvalued? And you say, a few of them are really overvalued, but you can find stuff that's undervalued. And that's what hopefully you can start seeing implemented. Well, it's already implemented in your portfolio, but hopefully start to give the kind of results we're predicting that does if money and momentum flows a little bit out of those Magnificent Six, which you can't stay in forever, or else they would become the entire market. And then finally, interest rates, when you start having those go down, it's like sailing with a tailwind instead of a headwind. And I'm not a good enough sailor to know if that really makes a difference, but I know it's a lot easier to run downhill than uphill. And that's really what it creates. Doesn't necessarily mean uphill can't be fast and that downhill's always good, but it's a lot easier to go downhill than uphill, and that's what we're looking at. So that's a big plus. And what it also shows is directionally where we can go. Whether we keep going down doesn't make as much difference. It's just a willingness to go down or up now, based on what's needed. And, for those of you who aren't feeling it yet, well, you're going to hear sometime soon that inflation is mitigated. And remember, with economic data, they're looking about a month after the quarter. So, no wonder that in early September is when we really figure out what was going on in July. So, and there's just some information there. And then also with employment, the good news is wage inflation has slowed. And that actually, you think, why is that good news? It's probably bad news for a lot of workers. This wage inflation was very nice for them, but it's really good news for companies because they were having a tough time keeping up, and that was actually hurting their profits. So to see a little bit of that break and then a little bit more unemployment, there's like that Goldilocks sweet spot. You don't want too much unemployment because then people can't spend money and the consumer gets bad, but you don't want, you don't want to have too many vacant jobs either. That's not good for businesses. So anyway, we're moving towards that Goldilocks scenario, and that's always a good sign. And then finally, and I love when you see this, to me, this just says risk off. And if you basically go, up and down the risk spectrum, how things should perform. And in my personal view, when commodities are down and stocks are up, that really means the economy is working well, because commodities are going down because of what I said earlier on artificial intelligence and other deflationary things. Because by definition, if commodities are going up, so is inflation, with the exception of something like gold that may have other attractions or uses. All right, and I believe that's going to be it before we get to our advanced planning section. So I'm going to pause and stop sharing, because whenever I keep sharing, people tend to not ask as many questions, and just look at you guys for about 20 seconds and see if anybody has a question. Or Kat Greer, you're on the call. You've been in Greece. You could tell us a little about that, what you saw economically over there, or anything else you want to add. Is there anything?
I don't think I have anything. I think Greece is thriving, and
I'd
like to be back there.
Is Greece thriving?
I think they're thriving, yeah.
That's very good for the health of the European Union, I would say. Because remember, think back to the Greek debt crisis when they weren't thriving.
True, we did. I did talk about that with some of the locals there. That's to them, that's a long time ago. So,
well, I'm sure that is. That's awesome. Well, that's good to hear. All right. Anybody else have anything of interest to share? Otherwise, we'll talk about tax loss harvesting. All of you want it. It's one of the few things in finance that everybody seems to want. Okay, let's go on into this. So tax loss harvesting, what it is and how it works. So first of all, and I do want to communicate this, that this is for taxable investments, and so like a joint account with your spouse or after tax money, not for IRAs or Roth IRAs. So everything we're talking about here, great strategies if you have taxable money. don't listen to it and think, oh, why am I not doing this in my IRA? The reason you're not doing it as your IRA is this is a tax strategy. It's really not an investment strategy. But what matters when you think about your taxable investments is not just your rate of return, but what is your rate of return net of taxes? And if every time we buy and sell something, we're paying a 20% short-term capital gains tax or a long-term capital gain, or short-term would be I said that because it's a lot of people's effective rate. Short term would be your marginal rate, or long term capital gains if you've owned it more than a year at 15%. That can hurt a lot of your return. I mean, if you really think about it, the best money manager in large cap area might be up 12%. The worst might be up 9. That's not 15% difference. And so when you understand it that way, it's not always worth taking the tax. All right. So with tax loss harvesting and the complexities, what is it? It's basically when you have losses in a portfolio that's taxable, even if it's a position we want to own, we go ahead and sell it. Typically, we'll buy something else that's similar. So a good example would be I own a large cap growth fund. I sell it and just own an S&P 500 index fund for 30 days. And then sell that other investment and buy the one we want to hold long term after 31 days. Or if the gains have been as big, maybe we're stuck with it. And the complexities of this can be such that you want to do it anytime you have considerable losses, but you drive yourself crazy and eat up your portfolio's performance if you did it every time there's a loss, because you're not going to day trade this thing. But that's one complexity. And then also navigating the substitutes and coming back is another one. But it's a very versatile strategy. And so one of the reasons we say it's versatile is it's not a matter for most of our clients of do you want to save on taxes? It's a matter of how much do you want to save on taxes? And one other reason we call this a versatile strategy is there's a lot of ways to do it. So with tax loss harvesting, let's think about if you have two ETFs and one has a gain, one has a bit of a loss. Well, two things can happen. One, I can sell the one at a loss and just take that loss. But I might even want to sell a little bit of the one that's at a gain to offset some of those gains and then buy back in at a higher basis. If we were talking to Kat about this, one of the things she would remind us about is how much you can carry forward. For years, it was $3,000. Kat, is that still right, or do you need to correct me on that?
I mean, you can use up to 3,000 if it's married filing jointly in a year as a loss. You can carry it forward as any amount.
Okay.
It's not utilized to offset.
No, and that's what I meant. But when you're carrying it forward, it's not like you can only carry it forward in $3,000 a year increments against ordinary income.
That's correct. Yeah.
And so eventually the point here is, guys, and this is one reason we like to get y'all's taxes when we're managing your taxable investments. A lot of times we'll want to know if you already have a loss carry forward. And some of our clients, especially after something like a financial crisis or, a big recession like COVID in 2020, will have losses before they come to us. And then if we know those are there and being carried forward, we can trade these accounts differently than if not. And that's what we mean about this. We don't have to know that information or about complexity. We don't have to know that type of information if we're managing an IRA. Here, you'd make different decisions if you would. So anyhow, and then there are lots of ways also of doing this strategy. And we sort of have, the way I would phrase it is we have one strategy and I'm just going to give you some examples you might fall in. One strategy if you have a taxable account that's less than $500,000. Another if you have a taxable account that's between $500,000 and $1 million, and another at $1 million above. There's other strategies on top of that, and think about this if this impacts you or somebody you know. If you already have a sizable position that's highly appreciated. So I have one client that comes to mind that just has a massive position in NVIDIA. It did not start that way, but he bought the company basically back before anybody knew what it was. So now we've got this massive position. You have to do all these tax loss harvesting and versatile strategies around that. A lot of times, if you're an executive at a company, you have a lot of single stock exposure. Some of you AT&T folks fit that bill and needed to diversify that. So anyhow, many ways of doing that. And I gave you all those examples so you can know if it's you. Okay. Then how are we going to do this and make sure we're doing it smart? So number one, and there's a lot of words on these slides. I'm just going to talk through and highlight the most important parts, but please read if you'd like. You do not ever want to be out of the market and miss out on rapid gains. Sometimes it's not going to be possible to do it where you're not out at least like one day or a certain amount of hours. But we don't want to be out for the full 30 days if we decide to sell something at a loss. There's just too much of a likelihood that after losses occur, the market's going to come back and rebound. Certainly, spring of 2020, we all lived through that. Many of us together is the poster child. Second, we do want to replace the assets, but you can't replace them with the exact same asset. You can replace them with a like asset, meaning similar, but not the same asset. So I could move, for example, from a active large cap fund into a index or passive large cap fund. And that would ironically count because it's a different type of strategy, but you don't want the strategies to be exactly the same. And then you don't want to overdo it because they do have wash rules if the IRS ever wants to get into it too much. And then they also just eating it up with trading costs. So there's a nice balance to it. What I find is we always look at the portfolios in the fourth quarter every year. And that's why we're doing this is the topic now. And then we also do it after big events or when people, come in and we're talking about potentially making changes and things of that nature or from doing the tax analysis. So those are usually our catalysts, but would love to hear y'all's and any questions or thoughts you might have so far. All right, well, now you guys get my disclaimer here. Remember, the tax mitigation is only part of the equation. And the reason I'm saying this is we have had people that almost let the tax tail wag the entire dog. And it's part of the equation. It's an important part, and it's an unliked part. But unfortunately, there just are times in a taxable account where no matter what we do, you're just going to have to pay taxes on it. And I always like to say that because sometimes it's like people think if there's big taxes in their taxable accounts, it's almost like something wrong happened. No, what that means is you made money, and we're going to mitigate it as much as possible, but you're never going to be able to mitigate all of it. Okay, so the risk is always going to be there. The cost is always going to be there. What are the two constants in life we all know? Tax and dying. There you are. And with that, we will open up to questions. And if you would like a review with myself or one of our other advisors, talk to us about anything to do with your relationship with us or financially outside. Please check the QR code there. Either Juliana, Barbara, or someone else will follow up with you, schedule that appointment, and look forward to talking with y'all. And me and